All right, welcome back for another episode of This Week in Charts via Carnival Trades and Wall Street for Main Street. If you're not done so already, give the video a thumbs up, like, comment, subscribe to the channel. Come find Jason on Patreon or come find me on carnivaltrades.com for swing trading alerts and analysis. Anyways, into the markets here. So last week we talked about this kind of impulsive breakdown that we had post FOMC, and we had a little bit of a continuation of that this week, really up until Thursday afternoon. If you look on the intraday here, we had some major selling really all day Thursday, and then a pretty good short squeeze starting around 1:30 p.m. and right into the close. And then Friday we had a little bit of a drift, kind of a float higher into the end of the week ahead of the holiday weekend. I think a lot of this, from some of the people I've talked to, I think a lot of what happened Thursday was a lot of institutions decided that that was just going to be the day that they did their tax law selling, they did their end of year cleanup, window dressing, window undressing, and a lot of that selling took place in the first half of the day. As soon as that sell liquidity dried up, they took off for the weekend, went out to, their families or wherever, got on a plane and took off. And that's where you got that kind of, the market was able to kind of recover there as that artificial sell liquidity, dried up immediately as soon as they left. So bottom line, irregardless, we did test basically 375. So we got down to, on Thursday, 374.77, and almost quite filled that gap from November 9th. If you look at the triple Qs here, we did fill that gap from November 9th here. So a round trip there to the November CPI. And, you guys remember I said when this happened, this is not going to last. It's a bear market rally. And you can see triple Qs have now round tripped that move there. And again, the Qs are much weaker here, as you can see, as we had that impulsive breakdown last week, and they really haven't bounced much. I mean, yes, you bounced from Thursday, but you've been making lower lows here. And the triple Qs continue to be, a leader to the downside. Now, I do think the Qs, at least possibly for the first couple of weeks in January. By the way, I'm working on my January 2023 forecast now, so that should be out on my channel within the next week. But I think a lot of these triple Q names, these tech names, the Amazons, think of like the ARKs, these beaten down growth stocks, Tesla, even Apple to an extent. This is trading at 52-week lows. A lot of this, you'll see some selling pressure here the last 2 weeks of the month, typically. And then we have what's called the January effect, where they get a nice bounce and you get a nice little rally because there's a lack of sellers after the tax law selling. And remember, you can't buy for 30 days, or you can't rebuy it for 30 days. But all that artificial selling is gone, and you get a pretty good snapback rally. And if we flip back over to the spiders here, I've been calling for a little bit more upside here lately. I've said that the market does need to bounce here. And if you take a look, we'll just get rid of the lines here. We're trying to put in a little bit of a base. We had a test candle on Thursday. We backed off of that support level, and now we're getting a bounce. I do think next week or two, maybe 3 weeks, we get a little bit of a relief rally. Part of that is, end of year stuff, getting out of the way, like I said, tax law selling, the January effect. And part of it is just, we tested support and it's good support, and we should bounce here. And that is kind of what I'm looking at here going into January. However, this is not, we're far from over through the worst of this, but at least for now, the market is a little bit oversold. It's trying to find a base here, and I do think we can rally up. At least, there's a gap to fill here at 390 on the spiders. You might even go up and test this downsloping trend line again. If we flip back here, you can see that goes all the way to the all-time highs. So those are your logical upside targets there. Those would be your major resistance levels. There's also a gap right up here at 399.40. So that would be basically right around that 400 whole round number, as well as the 200 moving average. You can see right there, 479. So those are your resistance levels. I'm not saying those are the levels necessarily get hit, but those are the levels I would look at here. If we do get a close below this low, however, so 370, that would be very problematic. And you got 360 basically right back on the table there. So just be aware of that. With the spiders, with the Qs, your big resistance area here is 280. If you get through that, it's 286.51. So I'm not even sure it gets through this level. It's possible. Where the Qs have shown weakness. Now, again, like I said, with January effect, all this extra tax loss sell liquidity can disappear and you can get a pretty good rally. So we'll definitely respect the market here, but we still have lows to make. We will take out these lows. And, eventually I'm looking for, a retrace too. If we flip back here, at least on the triple Qs back to this pre-pandemic high, possibly a little bit lower, maybe 220, maybe even 200. And for the spiders, I'm looking at, this 320 is a big area here. 340, it was a good area, but we got very close to it down here. We got to 348, and now we're putting in lower highs. So we'd expect this level to be a little less major and more of a speed bump. I think 320 and possibly 300 are going to be your bigger levels there on the spiders for 2023. So I'll give you a little bit of a preview there for the 2023 forecast. It's not going to go down in a straight line. We're not going to, it takes time, but those are kind of the levels I'm looking for at some point next year, maybe even within the next quarter or two. But anyways, let's flip over here to the semiconductors. So SMH, we talked about that breakdown last week. We closed below that green bar low, and again, kind of continuing to the downside. Another reason why I think this market can bounce, you guys know I love the semis as a leading indicator. And we can see on Thursday, we hit that 50% fib level. So that was a pretty good, and also the 200 whole round number. It's a good psychological level there as well. And, it was defended. So nothing major, didn't get a huge bounce off of it. But I think the semis, at least in the near term, this is really good support. We probably can go up and back test that kind of 215 area, which was that green bar low. If you get through that, there's a gap window right there, 220. And then of course the gap fill just shy of 225. We'll call it 224 there. You also have that 200 moving average down sloping there as well. So some levels there for the semis, but I think this is good support and we should get some type of relief rally off of that. By the way, take a look at NVIDIA here, leading semiconductor. Broke through that channel there. So that is a pretty ugly look there for NVIDIA. It is into good support though. So again, it could get a bounce here, but definitely some technical damage there to, one of the biggest semiconductors out there. Anyways, IGV, so cloud software, again, continues to be kind of a sloppy pattern here. Really all things considered. This eventually will roll over with everything else. You can take a look here on the weekly. I've been talking about this for a while. It's just more bearish chop, so we had a down move, inside bar, bearish chop, down move, kind of a bear kind of relief rally, down move, bearish consolidation, tried to break out, failed, down move, and now we're just kind of consolidating in this lower range. So again, IGV remains on the weaker side. Could it get a relief rally in January? Absolutely. But excuse me, this will head lower with the rest of the market here, but it's hanging in there for now, so we'll give it that. Dow Transports, this is important here. So we did break that yellow channel that we talked about last week, broke through that and confirmed. However, on the weekly, they did manage to save this inside bar, this green bar low here. So 13,475, and we did manage to close above that. We had a nice little test candle there. So that does open the door for a possible rally here. If this broke down, I would be very concerned about, the spiders, about the rest of the market going into, basically the immediate future. Remember, we talked about this weeks ago. I said, look, lower highs, spiders are making higher highs. This is a signal of weakness. And sure enough, we got that breakdown in the broad equity markets, last week. And so again, if we close below that level on a weekly basis here, that would be very problematic for the market. But for now, it's holding up. So it's another reason why I think we could get some type of a January effect rally, maybe the first couple of weeks there of some type of relief here. The transports probably would want to go up to, maybe 14.2. There's that red bar high. That's where you broke down from. So, and then you have the 200 moving average there, although these moving averages are pretty much minor at this point. We've traded through them so much, but that would be kind of your logical area there on the transports. But if you close the week below that level, there's serious problems and we need to be very careful. Anyways, let's get over to rates. So 10-year had a nice little bid here, up 2.23% on Friday, and it continued to push up really all week long. I told you guys I had that buy signal on the 30-year. It took, about a week or two to play out, but we finally got a nice bid here. And we made some nice money off that trade in carnivore trades. but I think we're probably getting into, I would say 39.5, maybe just a pierce of 40. You have a pivot low right there. Is pretty good resistance for the TYX. So, typically when you get these moves, you get a big move and then you have a sharp pullback, especially into, a good support level. So this goes back quite a while. There's a big pivot high. You broke through that pivot high and we tested that area. Usually the first test will get defended and you'll get a good bounce off of that. That's part of the reason why I based that trade off the long yield. But we'll see what happens. We have, there's resistance up here. If we start to get a slowdown, and I want to show you guys the yield curves. If you can give me 1 second here, I'll pull them up for you. All right, here we go. So this is 2s and 10s. And you can see we had a nice little pop off the lows here. So the yield curves are starting to normalize just a little bit. Same thing with the 3-month 10-year. Even the 5s and 30s and 10s and 30s are starting to back off a little bit. And generally what this means is we're getting closer to a recession. So if that happens, it's likely that bonds could get a bid here. You might put in a lower high, and the TYX, TNX, all the yields might have to do some more backing and filling here. But that pattern here to flip back over, it's not, this isn't necessarily like a huge move. Like we've had nice moves off the lows previously, and they were all faded. So this can get faded. Don't think we're out of the woods here, but just bear in mind that we are likely getting closer and closer here to much more of a slowdown, and bonds are starting to reflect that. As far as the 2-year is concerned via ZT here, you still have this kind of micro inside bar here, so bullish inside bar on the daily, and that head and shoulder target has still not been hit yet. So there is a chance we can get up there, maybe in the next couple of weeks. But if this loses this green bar low here, we're going to go back down and test this area, and then if that gets closed below, so if we were to just kind of extend this out, if you close below that, this pattern has failed, and the 2-year yield is going to go a lot higher, which means the Fed has more work to do. So just bear that in mind here with bonds. As far as high yield, let's look at HYG. We still have kind of a bearish channel here on that. You can see it there on the weekly as well as JNK. So I'm watching this kind of bear pennant, bear wedge here as well. If this breaks down, that's going to be problematic for the market as well. So keep those on your radar. Anyways, let's get over to home builders, XHB here. So again, continuing to hold this green bar, and it's holding up well. So that's really all you can say right now. If you close below this, huge problems. This will eventually break down here, especially as, like I said, as we get closer and closer to a recession and more of a slowdown. This is going to be problematic for the housing market. ITB is holding up as well. This one might have another little run in it, though. It's holding up well. I do think this area will be a short. It's going to be one of the bigger short areas. You're not going to want to be owning home builders in 2023. I'll pretty much just say that to you right now. VNQ here, so general real estate equities. We talked about this last Friday. They saved this green bar here by pennies, and we closed below that level on Monday. So this inverse head and shoulders here, that's failed. So there's no more 93 target. We've broken that pattern. We filled the gap. 84 will be resistance on the upside. You can see we actually tested it on Wednesday. That was resistance. If you get through that, maybe you can get up to this gap, but VNQ is very weak. I would not be involved in this right now on the long side. XLF here, so over to financials. Again, like the transports, we talked about this 2 weeks ago. I said, look, the financials are telling us something here. KRE just doesn't break down like that. Bank of America doesn't just break down like that. Wells Fargo, if there's not, this doesn't just happen unless there's some major problems here. But anyways, financials here, XLF, continue to move down, and now we're just kind of chopping sideways. You can make a case that you're starting to have kind of a bearish channel here. So down move, and you're just inside of that. So again, I think financials will be a sector you want to be short as well going into 2023. Can they get a bounce up to gap fill? Absolutely, especially if everything gets a bid here. But I do not like XLF going into 2023. Broker dealers here, same thing. Down move, and now just kind of chopping with like a little bear wedge there. May want to get up to 460 here in the near term, but that will be resistance eventually. This is going back to 400. And then, probably will make new lows as well. But for now, it's holding up, better than most things. So we'll give it that. All right, flipping over to energy. So crude. Coming off the lows again this week, it probably wants to go up and test, I would say, 82 to 83 here in the near term. You've got a little bit of a pivot there. A 50 moving average is a little bit more minor. I'm not sold on crude right now. I would have preferred if you had a big tail candle or an engulfing reversal with volume at the lows. We'll see what it does. If it can give you kind of a bullish pattern, kind of a sideways chop, that it can advance here. If not, we'll see how it behaves at 82, 83. It could still roll over and hit that target after all. I told you guys, the low, mid 60s to upper 60s would be a good buy area for crude. So we'll see what it does here. In the near term, I do think you want to go up and test 82, 83 for now. But again, nothing really definitive for crude, at least in the next couple of weeks. But we'll see how it reacts once it gets to that level. As far as the energy equities like XLE, this is still holding up really well. Definitely leading the market. And it was up pretty nicely on Friday with pretty much a flat tape. But again, you still have kind of a down move here and you're below this resistance level. So if this breaks, I think eventually you're going to want to go and test this trend line. So again, I'm still in the camp that these energy equities are still in backing and filling mode. XOP, same kind of deal there. I'm looking for probably 120 there on the downside. That's going to be pretty good buy area for a trade. OIH probably still wants to go to 250, although this is holding up really well as well. Up 3.78% on Friday. And it's basically, it's not that far off the highs. So energy equity is still holding up really well. I just would not be a buyer here. I think they still have a little bit more backing and filling to do. All right, flipping over to uranium. So CCJ, nothing really new here to report from this week. Again, I'm still in the camp that you kind of have this red bar here. You're holding up for now, but I think 16 to 18 is going to be kind of your buy zone. I would wait for that right now. I would not be a buyer right now. We did have a URNM do a split this week, so that did change the numbers up. But again, just to line it up with the previous area, about 22 to 2250, you've got this. This is where you broke out from. You do have kind of a wedge pattern here as well. So if it can hold that, you could potentially break it to the upside. So we'll just be watching for that here. But I'm not a huge fan of uranium right now. I do think it's still doing some backing and filling. Some of the potash names, MOS. This did hit a level here on the weekly. You did get into that 100-week moving average, so we'll see if that can get a bid off of that. So not a bad level there and potentially higher lows in play. Still just working off a big parabolic move here. Same thing you can see obviously with NTR, but look at DBC here as well. Just a big, if we go to the monthly, a huge parabolic move, and you're working that off. So we're now getting into that 20 moving average area. You could get a bid off of that. Usually when you come down into that after a big move, you get a bid. So nothing to say it can't get a pop here, but this is a long base of consolidation that broke down. So it's going to take some time to get through that. And again, I just think ag can be a play in 2023 and beyond. But for right now, I still think it's just got a lot of digestion to do here still. Nat gas finally hit this old trend line here that we've been following for some time. And I'll just flip over down to the daily here so we can see it a little bit better. But again, going back to really mid-2020, this trend line has been a really good area of support. The only thing I'll caution against is that we've hit it once, and then you had, 4 months or so, then about, 7, 8 months, and then almost, probably 7 or 8 months again, and then again, 7, 8 months, and now we're hitting it again after just 2 or 3 months. So possibly a little bit of weakening momentum. Just be careful with that. But I do think this trend line does get defended here, and Nat gas gets a bid in the near term. So we'll watch that next week. We got that $5 pierce. I told you guys I like that level if we get down there in a straight line, and we did. So we'll see what Nat gas does next week. But nice little bid off of that area for now. Over to the dollar index, DXY. Not a whole lot of action going on. Basically just more chop here. I do think this has one more flush here, possibly to 102, maybe a little bit of a pierce of 102. So we'll see what that does over the next couple of weeks. Gold here holding up really well, kind of putting in higher lows and higher highs. I would prefer a little bit more of a straight pattern here, but I do think 1875 is a possibility here over the next couple of weeks. I do not think it gets through that right away, though. So that will be good resistance for gold in the near term. GDX, I would say right around 32. Is going to be a good area. That should coincide with 1875 on gold. But gold and gold equities holding up really well. And I do think they will be a trade in 2023 as well, although I do not think they have. Yeah, I would not be a buyer right here. So I'll just put it that way. But same thing with silver here. This had a really nice run off the lows, but again, it's overbought, it's extended, it needs to pull back. You can see this channel here. I really like this channel, by the way, but you're coming into some resistance here. It doesn't mean we can't pierce through it, but looking at it from a risk rewards perspective, would you rather be a buyer here, or would you, excuse me, would you rather be a buyer here where there's resistance is here? Here's your red bar, your breakdown bar, 25 whole round number, trend line. So your upside is, $1 here. But if we were to back off, we could get down to 22, 23, maybe even down to 21 on a correction. So wait for the pullback here. I know everybody wants to get in silver right now. Wait for it to pull back. It will. Doesn't mean it can't have a little bit more of a bid here in the near term, but it's getting close to resistance. So just be patient with it, and it'll give you a good trade. Platinum here continues to hold up. I told you guys this trend line would be nice here. It came down into that this week, and it chopped around for a bit, and then huge bid on Friday, up 4.7%. So nice move for platinum. If this breaks this upper trend line, it may want to make a run at the highs. I'm not sure if it does that here. I did tell you guys this is going to 1200. I don't know if it's going to do that right now, but it's holding up really well. So, I'd say it has a fair shot at the very least. Platinum has been a beast so far, really since the lows in September. Copper here. Basically, again, just kind of stuck sideways here. It's holding up. You do have on the weekly, an inside bar here. So bullish move, 1, 2, 3 pullback. If it can close, again, if it can close above 396 on a weekly basis, I'd say you basically negated this bear pattern, and copper can push up to that that 420 area. But for right now, it's still stuck in that channel. So just be careful with copper here. Bitcoin, not a whole lot to say. As you'd expect, it's really just gone sideways. And again, very ugly here on the weekly. So down move, that's not a good bear. That's a good bear pattern. That's not good for bulls. Very, very weak here. It does want to go down and probably test 10 or 11,000 here. So just be careful with that. All right, flipping it back over to the spiders. Again, we had a nice little test here of this gap, and basically, for all intents and purposes, we filled it. And now we're kind of just chopping around. I do think we get a relief bid into probably the early portion of January, maybe even the next week. We'll probably get some light volume. All the big boys are most likely gone for the majority of next week, and it's a shortened trading week as well. So unless we get major geopolitical news or something of that nature, I do think it's relatively quiet. Now we give the market a neutral to upside bias. It does look to me like most of the tax loss selling has been done by anybody with money. So there might be some retail tax loss selling going on, but that's not going to move the market yet. So I think the market probably gets, I'll give it a neutral to upside bias going into the end of the year. And then I think we can get a little bit more of a sustained rally, maybe in the early portion of January. After that, I think we come into a little bit more of a risk period, but I'll get into that more so as we get closer. Anyways, guys, I'm going to wrap it up here. Come find Jason on Patreon. Come find me on carnivoretrades.com. I'll talk to you guys all next week.